It takes 1,000 traders executing a buy position to have the same effect as one central bank. And how are we getting on, guys? Hope everyone is well. Today, I basically wanted to run through my outlook on order blocks or points of interest. I know there's a few different names for them, but I wanted to kind of give a run through on what they are, why I use them, how I use them, just so that you can have a bit of a better understanding yourself into what they are, their importance, and how they are, a very important component in my trading plan and trading strategy. So I just wanted to walk through that now. I guess obviously the best place to start with this is understanding what is an order block, what is a point of interest. And I guess I'll explain simply and then into some more depth. And, in simple terms, an order block is simply an area in the market that holds relevance. And what I mean by that is that it's a point in the market or a region or an area in the market that when price approaches, we know that price is going to have some form of reaction. And the reason why this happens is because there are certain regions in the market where, and this kind of stems back to, Sir Richard Wyckoff's composite man theory, where obviously he explains that you should view the market as if there was one man controlling it. Obviously my understanding of this is that you have the smart money. And the smart money is, your central banks, your people that play with such high liquidity and can provide such high lot sizes into the market that they basically have full control. Because, you've got to think about this. If the average trader places 10 lots of trade on average, okay, random number, let's say the average trader places 10 lots. Let's say the average central bank places a position that's worth 10,000 lots. Instantly it takes 1,000 traders, and let's say it's a buy position, it takes 1,000 traders executing a buy position to have the same effect as one central bank. And because they can place such high liquidity positions, the simple execution of those can actually move the market because introducing lots of buying power is introducing demand into the market because there's more lots going into the buy side, which means that there's a higher demand for that XYZ, it moves the market up. On the flip side with supply, if a lot of sell positions are open, we know that that's going to cause the market to slightly depreciate because there's so much force on that downside. And what's happening is when these positions are opened, there's footprints left over in the markets, which we know hold relevance, and we know the market will react to when it goes back. And I mean, I'm not going to go into too much depth about that now. We could be here for an hour of me talking about exactly how this works, X, Y, Z, but I just really want to explain to you guys, why and how I use them. And the why really is because it has a high success rate. It's pretty obvious, but the first thing I'm trying to gain with my trading strategy is an edge, right? All I'm looking for is an edge. And I find that what happens is when I can correctly identify these points of interest, it gives me an edge because more often than not, when they tap into the points of interest, they react and they do something which I can predict. Now, if we kind of just look in the structure of this market, a very simple market, we can clearly see we had the bullishness here. Within that, we're expecting price. Within this bullishness, we've had the impulse, correction, impulse, correction, impulse. And obviously we can see the corrections trading down now. And, for all traders, it's obviously about making predictions. Trading is about making predictions of what's going to happen next in the market. And, obviously I know what should happen here, and what is most likely to happen here, is that this correctional wave is going to trade us down. It's going to end somewhere before it reverses and creates the next impulsive wave. But obviously, for us to get involved in the next impulsive wave, the best position for us to capitalize from is the exact point within which it reverses, because then we're in at the start of the move. And what a point of interest allows us to do is identify points where price is likely to reverse. And obviously, again, keeping it quite simple, when it comes to demand zones, okay, what I'm looking for, and we can even type this in. So for demand, that equals a sell candle / region before a heavy buy off. Okay, so it's a sell candle or a sell region before a heavy buy off. And you can see that this region down here perfectly demonstrates that if we change that to a demand zone, because we can see a sell candle or a sell region down here. Before then, we've had a heavy buy. And what that represents is a point of interest. Because we know the smart money operators, the composite man has been active there. They have positions open that need mitigating. And if you want me to run into a bit more depth on mitigation and why the points of interest really hold relevance in depth, I can do that in a separate video. But for now, demand zones represent a sell candle or a sell region before a heavy buy off. So we can see that one is relevant there. So I know that price is actually going to be quite likely to come back down into this demand zone before reversing and making that next impulsive wave higher. So what I would do is I would place an alert at this level, and then when price comes to tap into that level, I know, right, okay, let's get ready to look for a reversal, or in my eyes, let's look for signs of a accumulation. If you're not familiar with what an accumulation is, it is a Wyckoff schematic. If you just search up Wyckoff, Richard Wyckoff, there's many articles and many studies that explain his theories and his schematics. So boom, that is me on the highest time frame. Within my top-down analysis, I've figured out what's going on. Now, if we go lower, and we've now made the assumption that price is going to continue trading down into this zone, again, we can see that what we've had here is an impulse, a correction, and an impulse. Now what we're working with is this is the wave lower. So the correction should trade up, protect this high, but reverse somewhere within it. There's two zones here, which represent, in my eyes, a supply zone, because it is a buy candle / region before a heavy sell-off. And what we can see in both examples here is we've had a buy candle or a buy region before a heavy sell-off. And what's really important about this is, has price actually returned to that zone afterwards? Here, it got close, but it never tapped it, which means that that zone is definitely valid. In this example, we have a buy candle before, again, a heavy sell-off. And we can see that recently now price has come in to tap that. So let's actually look into this. Is this going to be relevant? And as we then look into this market, we can see, right, if we follow structure once again, well, actually what's happened here is this should have been a protected low. So the break of that represents a break of structure. We've stopped creating higher highs and higher lows. So we've now just created a lower low. It seems like right now a lower high could be getting created. Again, we're not going to know that until we've had the break of structure down here. So again, we can place an alert there. So I'm notified when the break of structure happens. But what I would probably have done, looking inside of this move that broke structure, is I would have tried to identify supply zones. So I would have looked inside, I would have said, right, we have a buy candle here, which could represent a zone, supply zone. See, that one there's already been tapped. that there already been tapped. So I would be seeing this as the zone. If we see price sort of react, if we see this break of structure, that could be an indication that we're then making the move lower, or price may decide it wants to actually move higher, mitigate this, if it's not ready to reverse just yet. So yeah, just remembering the supply is a buy candle or buy region before a heavy sell-off. And then obviously we understand demand is a sell region, or a sell candle before a heavy buy. So that's really how to identify them. You should be seeing that when price approaches them like it has here, we start to see price losing momentum. We get a little bit of sideways movement because price has been affected by this zone, and it's figuring out what it's going to do moving forward. And obviously we're then looking inside of that to see any signs of price doing something different, so that we then know how to make our predictions moving forward. And after we've seen price come into here, what's quite relevant is that we've seen a break of structure, which would suggest, of course, a break and change in trend, and a reversal lower. So therefore, I'm going to be looking for any confirmation for some sell entries. I'd have an alert set at the potential break of structure, and I'd also have an alert set up here, because if it raises above this high, it's obviously wanting to move higher. So hopefully that is a nice little insight into points of interest, into supply and demand zones. Again, I've not touched too deeply into this because, the topic alone takes hours to discuss, and it's something that, I've ran through in my mentorship before. It's something that, I would do in a one-on-one session, but unfortunately not enough time in a video like this. But, hopefully you guys have enjoyed nonetheless and learned things. If you've got any questions, please do feel free to message, leave a comment, get in touch, and I'll make sure to get back and answer those. But yeah, I appreciate you guys watching. Hopefully you've learned a fair bit from this, and I will see you next time I make another video. Take care, guys.